Welcome back to Morning Markets on Tuesday, the 17th of August. In terms of economic data prints, a relatively light day yesterday, but some more information coming through this morning. US Treasuries saw a continuation of Friday's recovery effort, evident in the lower bond yield, gaining further support from slightly weaker industrial production and retail sales out of China. So in China, retail sales were up 8.5% year on year, expected to be around 11.5%. Industrial production was up 6.4% year on year, expected to be around 7.8%. So a slight miss there in terms of expectations. There was also a rise in geopolitical angst, which heightened over the weekend with Taliban forces taking control of Afghanistan. We also had signals from the president of the Boston Federal Reserve Bank, Eric Rosengren, that the Fed is moving closer to the target on employment, signaling that they may be moving closer towards moderating the $120 billion per month bond purchase program, but not yet raising interest rates, with the view driven by higher inflation prints and 2 consecutive months of strong job creation, taking the unemployment rate down to 5.4%. The Treasury market reaction was relatively moderated. The wider guidance from the Federal Open Market Committee dot plots still point towards rate hikes more likely to be the back end of 2022 or 2023. We may find out more about this at the Jackson Hole Symposium later in the month. Just in terms of that reaction, the US 2-year Treasury yield was up around 0.2 basis points to 0.2%. The 10-year was actually in around 1.2 basis points to 1.26%, and the 30-year Treasury yield was in around 0.2 basis points to 1.92%. This development of yields moving lower from Friday can be seen on screen now. We can also see the moves yesterday with yields pulling in on the back of the data prints and then starting to push out post the reporting of the views by the federal policy, and the potential that they are moving closer towards that target, thus closing the tapering given that strong employment and growth backdrop in the US. Equity markets yesterday were generally softer, a lot of this washing through overnight into Asia given the points previously noted there. We also had the New York Federal Reserve Barometer of manufacturing business activity within the state of New York. This came in a little bit softer than expected. It fell from a level of 25 to 18.3, given the challenges within the state of accessing materials as supply chains remain stretched at this point in time. It's worthy to note that a reading above zero demonstrates the index is expanding. Looking ahead, the index is anticipated to pick up as businesses and investment in supply chains is expected to ease the current pressures, better enabling output to meet the solid demand levels which we're seeing. In the UK this morning, we received an update on unemployment levels at the end of the second quarter. The rate of unemployment fell to 4.7% from 4.9% in the January to March period, coming in around 0.1% below expectation, so better reading there. And now just 0.8% below where we were pre-pandemic. So it's shown a good recovery in the labour market following the relaxation of many coronavirus restrictions. There was still strong demand from employers to take on labour, with the rise in vaccines driving vacancies and vaccines driving a rise in wages to attract workers at this point in time. That's all for today. Thank you very much for watching. We look forward to bringing you up to date tomorrow here on Morning Markets.
Subscribing to the True Potential YouTube channel is quick and easy. Simply go to the channel on your desktop or through the YouTube app on your phone and click the subscribe button. You can then press the notification bell symbol if you wish to be notified as and when new videos are released. Doing this is a great way to keep yourself updated with market developments and personal finance insights. Thank you to everyone who has subscribed, and we look forward to continuing to help you do more with your money.